The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to this Wednesday edition of Squawk Box Europe. I'm Steve Sedgwick and these are your headlines. Christine Lagarde refusing to declare an end to the ECB cutting cycle, even as she hails Eurozone resilience. The ECB President telling this very channel she's weighing all potential risks.
I think the job of a central banker is never done. So we tamed inflation so far. We are in a good place, as I said, but we have to anticipate anything happening.
ASML posts net bookings ahead of expectations in the third quarter and says it expects stable sales next year. Now that's despite a significant China decline. And maybe a glimmer of hope for the luxury space. LVMH posting a 1% boost in third quarter sales thanks to a rebound in the aforementioned China. Whilst in Switzerland, the CEO of luxury watchmaker Breitling tells Carolyn, any ease in political tensions will boost the sector.
Buying a luxury good, it has a lot to do with the psychological environment. You need to feel good to buy a luxury good, and more good news you have, more positive is the consumption.
A very good morning to you all. What did you think of the markets yesterday, everybody? I thought it was a typical example, so I didn't give you a chance to answer. Okay? Okay, good. Right. Now, I thought it was a typical day where worlds collide. And it made me thinking, when worlds collide, and it rang a bell, and it was a 1951 sci-fi movie where a rogue star was coming basically to destroy Earth. And it was about the plans to build an ark, so to speak, as well. But when I say worlds collide, I'm talking about what's going on with China and the US and the ongoing spat there. Besant, Trump on one side, the Chinese on the other with their rare earth policies and the ports shenanigans there as well. Then you've got the interest rate scenario, and we're going to hear a lot from central bankers from the IMF meetings in Washington. And so a lot of people poring over what Jay Powell said yesterday as well. Then you've got the earnings season as well. And let's be honest about it, the banks are knocking the ball out of the park. But the problem is, have we already got the full valuations in US banks when one or two of them are above 2 times price to book? And a couple of years ago, you couldn't find them really much north of 1. So is it fully priced in? So you've got so far the geopolitics in terms of the trade wars, you've got rates, you've got earnings, but you've also got this trade in the background about AI, and people are trying to work out a lot of commentary in the last 48 hours from central bankers and from bankers themselves about where we're at on the AI trade and where we're at in terms of irrational exuberance. Two things I will say to you, which are a bit of a caveat to the exuberance at the moment. One, VIX has picked up. Have you noticed? Some of you have. The volatility indicator, I don't think it's a great barometer of fear, to be honest. It's just my view. But I think it's trading above 20 now, which means that people do see the volatility elevated and hence the risks elevated. And if I get a little bit technical for you, further down the skew, the more out the money puts, they are certainly picking up a bit of premium at the moment. And the second indicator is no matter what happens in these markets, which are oscillating aggressively, gold still goes up. Now, is gold a tactical trade, a thematic trade, or quite frankly, the mother of all momentum trades at the moment? I'll leave all that hanging there. Worlds collide. Have a look at the movie. It's very good. The outlook for global economic growth remains dim, according to the IMF, despite unexpected resilience amid trade turmoil. The group warned the full impact of US President Donald Trump's tariffs is yet to be felt. Well, of course it's yet to be felt because it's ongoing. We don't have a status quo, do we? We don't have a final number on what the Trump tariffs are. Originally, they were massive figures on the April 2nd, and then the actual level of tariffs came down from those levels we quoted ad infinitum about them being equivalent to the early 30s, and now they appear to be picking up again. So the IMF has actually upgraded its expectations for global growth this year to 3.2%, but left next year's forecast unchanged. The IMF raised its growth expectations for the United States over the next 2 years, but the economy is expected to expand by less than it did last year. It also upgraded the UK forecast for this year and said sustainable growth is expected in the Eurozone, but at the cost of rising debt and increased government spending, which takes us back to, of course, those concerns we have about fixed income and concerns which are leading people to gold. The IMF's chief economist walked Kern through the updated outlook.
First, I would want to start with the good news. I mean, back in April, when we were putting together our projections for the year in the middle of, an unprecedented increase in tariffs from the US and the rest of the world, we had a range of scenarios. The situation was very fluid, and there was a downgrade in growth, and it ranged from modest to significant. And so now, 6 months later, where are we? And our answer is, well, the good news is we're kind of at the modest end of the range. So that's the good news. It doesn't mean that the tariff shock has had no impact. We can see the impact of the tariff shock in the US and elsewhere. But private sector has adapted. There was a lot of rerouting of supply chains, import front loadings in the first part of the year. The tariff shock itself has been scaled back. There were trade deals, many exemptions. The effective tariff rate that we are calculating now, slightly under 20%. It was projected before to be around maybe 25%. Now, close to 20% is still elevated. It's still a high tariff rate from the US and the rest of the world. And then there are a number of other things that have helped the economy do better. Financial conditions have remained very accommodating. We're in the middle of a very strong tech, AI-related investment surge. Fiscal policy in a number of countries is basically giving some more fuel to the economy in China, in Germany, in the US next year. So you put all of these things together, and our growth number is actually very similar for 2025 to what we had a year ago, 3.2%, even if we expect a little bit of a slowdown next year to 3.1%.
Well, just as you dust off your report, we have the US and China escalating on a trade war. How big a worry is that still as we count down to the end of the year?
Well, it's a stark reminder, if we needed one, that we're in an environment in which trade policy uncertainty is with us. There could be flare-ups in trade relations. They could be very damaging to the global economy. For instance, we did a downside scenario in our report where we try to factor in some of these tensions. Of course, not the specific details of what's happening between the US and China right now, but sort of thinking about what could go wrong in the trade space. And it's easy to get global output coming down by 0.3 percentage point this year and next if we have trade tensions that are escalating again. So this is really an important reminder that we need to achieve clear, transparent trade agreements, bring back stability, restore transparency, allow businesses to make plans without fearing about how they might be appended in the future.
Now, the lovely Brittany, who's my producer, had the temerity to take his name out of my problem and just said chief economist, but I'm going to do it because I love his name, Pierre-Olivier Grinchas. What a great name. Didn't you just love his line, though? Thinking about what could go wrong in the trade space. That will keep you going a long time, sir. Anyway, speaking to CNBC, the ECB President Christine Lagarde appeared to indicate an openness to potential further rate cuts, saying the job of a central banker is never done. No, I'm sure it's not, but stressing, a bit like an anchor, but stressing a data-dependent approach. The ECB chief also struck an optimistic tone on economic conditions within Europe.
I have been quite surprised at how resilient our economies have been, and that has been the case in Europe. So we feared the worst, and we had the bad, but it wasn't as bad as we had anticipated. In terms of growth, inflation, employment, I think that the economies have been very resilient and much more so than we had anticipated.
That was Sarah Eisen there talking to the ECB president. Right, we're going to have plenty more from Washington, D.C. across CNBC today. Conversations with Carlos Cuerpo, the Spanish economy minister, and the ECB governing council members Joachim Nagel, François Villard de Gallo, almost as good as his name, Gourinchas, isn't it? All streaming on the CNBC International Live YouTube page this afternoon. The Fed chair, Jerome Powell, signalled he could be ready to support another rate cut this month, warning that the US labour market is softening. Speaking at an NABE conference in Philadelphia, the Fed chair said that even without fresh data, delayed, of course, because of the US government shutdown, the central bank had enough evidence of cooling in the jobs market.
While the unemployment rate remained low through August. Payroll gains have slowed sharply, likely in part due to a decline in labor force growth due to lower immigration and lower labor force participation. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. While official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue their downward trajectories.
Who needs payroll data, eh? When you've got the Fed saying it's weakening regardless. We'll come to our guest with that in a few moments. JP Morgan CEO Jamie Dimon, he weighed in on a whole host of issues, specifically about the US economy at a Fortune event in New York, suggesting markets may well be overly optimistic.
The consumer's doing fine. Unemployment's good. Wages not going up so much. Labor's gotten a little bit weaker. Wholesale credit's been good, but I suspect it's, we borrowed and spent $10 trillion over the last 6 years. Of course, that's going to drive corporate profits and corporate credit, so that may weaken. The whole world is a deficit issue. And so I'm kind of in the cautious category, and also made cautious by the fact that asset prices are high, in some form of bubble territory, but that doesn't mean they can't go up 20% more. Credit spreads are historical lows. So it looks like the market world is pricing in, I'm going to call it a continued soft landing.
I love that. That was the ultimate investment banker hedging. Ben Emmons, CIO and founder at FedWatch Advisors. I love that. I'll quote Jamie Dimon. Well, I think we're in bubble territory. Doesn't mean to say we can't go another 20% higher. Ben, what are you reading in the market at the moment?
Well, I think that's what the markets are doing. It's still discounting this soft landing and all the investment going into AI, and perhaps more investment as we go from here, because this rare story is hitting the tapes too, and as I think getting people attention against the backdrop, as you just described, like Powell is looking at this labor market continue to soften. That gives it enough reason to continue keeping rates on a trajectory in lower, no matter how many rate cuts will follow, or at least several. And so it keeps this market into a very, brimming sort of state, if I think of it. Like, you get a little bit of drawdowns here and there on the trade tension, but then it just continues to actually march a bit higher. In other words, the buy the dip mentality is pretty strong right now.
Yeah, Ben, I mean, look, the old adages, I think, are pretty good, a lot of them as well. And perhaps amongst the oldest, it goes back to the Old Testament of markets, is the bears make sense and the bulls make money. To be fair, that's kind of the way of it at the moment, isn't it? Do you see any time when actually it's the bears who are going to start making money rather than the bulls?
Well, if that were to happen, so the bears making money, then we're getting a completely flip of the scenario. In other words, we do dip really quickly into a deep recession as a result of the trade tensions really escalating to such extent that everything just gets to a standstill and then starts to contract. But that's not exactly where we are. Right? And I think one of the other guests pointed out really well, I think there's a lot of tariffs out there, a lot of discussion. Ultimately, it's just negotiations, and it hasn't really materialized in such a damage that we were fearing. Just like Lagarde said, the economies remain resilient. Probably can, at least for not cushion any type of major negative effects of the trade war and the tariffs. So the bears will continue to lose money in this market, unfortunately for them.
Yeah, look, I'm going to get back to this AI. I love the fact today that there's an article in the FT, which I think is replicating what OpenAI have said, which is they're going to create a 5-year business. Well, it's nice to know they've got a 5-year plan to grow their revenues from circa $12 billion up to, a 6-figure level of revenue, given the fact that they've got commitments to spend money of over $1 trillion. Does none of that kind of stuff touch the sides on our worries?
Yeah, I think it does, because, if you think back of this company called Global Crossing, right? They were somewhat similar as OpenAI in terms of its innovative approach to these underwater internet cables, right? They had a ton of money to spend on that, and they did, and they put it in the oceans, and ultimately Global Crossing went out of business because it just didn't make any money itself as a company. And that's potentially overhanging this OpenAI to an extent too, at least it's getting to the point where all this commitment that they have of all these dollars, it's just not really generating any type of profitability. And that will be, I think, also, too, a moment that the bears will make money, because I think part of this drive that we had in markets currently was, and OpenAI is such a dominant news force currently that it drives up markets quickly. But if it doesn't generate profits, then the bears come in and they make money.
Yeah. Ben, I talked at the top of the show about worlds colliding and the key issues in the market, from earnings to rates to trade to the aforementioned AI trade as well. What do you think is the next driver of the market to the upside, given the fact that we've said for the moment the bears are on the back foot?
Well, it would be on the investment side, because if you just look at the list of companies and countries on the White House website, barely anything of that has been done so far. And these are also big American companies like Apple and Meta and so forth. So the investment that's going to be put into the economy in the course of the next couple of quarters will really affect economic activity and therefore also affect markets, particularly if you think of earnings growth, which is obviously driven by GDP growth. We step into this new earnings season. The expectations are lofty, but not as lofty. And I think this is where the drive will be to the next upside, that the economy continues to surprise because of a push of investment coming in, which drives up earnings growth.
Yeah. Ben, those of us who've been around longer than 10 minutes always look for canaries in the coal mine in private markets, in corporate bond markets, in delinquencies, in some of those debts as well. And there's signs of this at the periphery at the moment, and a couple of notable names, Tricolor and First Brands and what have you. Do you see anything in this rush of money into the private credit stroke debt arena, which is worrisome about credit standards, lending standards, and therefore is going to create broader problems in the corporate debt market, which could then have ramifications for the equity market?
Yeah, so far these two names that you mentioned are, let's say, idiosyncratic, with their own specific business-related issues. But there's some linkage there of, let's say, the First Brands is a pretty large first lien loan that sits in CLOs, and those CLOs have ETFs, and those ETFs are held by a lot of financial advisors. So there's some financial linkage there that can amplify if you're getting more of these cases coming to surface. And private credit, the average interest rate there is roughly about 10 to 15%. And it stayed that way. That's good for the investors, but not necessarily good for the economies, for the companies that are paying that interest if they slow down or deal with idiosyncratic business downturns like First Brands did. So I think that is the risk in private credit, high interest costs. It could hit several of these companies. They have those companies, first lien loans sitting in these structures like CLOs and then ETFs. That could be the amplifying effect. So we have to watch it. I mean, at this moment, that doesn't seem to be broad, but it could broaden, and I think that's the key issue here.
Yeah, Ben, how much does that sector and the broader market need more rate cuts from the Fed? I mean, there's a certain property developer, stroke president, who really wants some, apparently.
Yeah, the market will try to discount more rate cuts as a result if that financial instability starts to develop itself further. Yeah. I do think the Fed was a keen eye on it. So Powell's, again, yesterday, it was on the minutes too. So that you get that kind of idea, right? If you're getting more First Brands type of examples, the market starts pricing in more rate cuts and yields go lower. So I think that's clearly a parallel there. Yeah.
Good to see you today, Ben. Thank you very much indeed for joining us. Ben Emmons, who is the CIO and founder at Fed Watch Advisors. Right. So the banks, what are they relying on at the moment? I think a bit of everything. It's a nice scenario for them. They've had the trading, they've had the consumer, and now with the slew of banks reporting stateside yesterday, they're also getting the deal making, aren't they? JP Morgan raised its full-year net interest income forecast after it beat third quarter profit expectations, boosted by strong, trading and investment banking performances. Jamie Dimon warned of a heightened degree of uncertainty from tariffs, geopolitics and elevated asset prices. But as we heard in the last quote, he still thinks we could go another 20% potentially. Goldman Sachs beat third quarter expectations driven by stronger than expected investment banking and fixed income trading. Profit jumped almost 40% on the year to top $4 billion. But shares closed lower after a miss for its stock trading business. And Citigroup also beat third quarter estimates, with every division at the bank generating record revenue during the period. Shares surged following the strong performance. And what have we got? Wells Fargo also jumped after the bank beat third quarter profit estimates and lifted its profitability target. Earlier this year, the Fed lifted an asset cap on the lender imposed over its fake accounts scandal. And we're going to have plenty more numbers out today. Bank of America set to report before the opening bell on Wall Street. Our US colleagues will be speaking exclusively to Brian Moynihan, 3:30 London time. Right, coming up on this show, France's reinstalled Prime Minister looks set to live another day. Wow, there you go. Ahead of a fresh no confidence vote in his government. Gosh, it's been days since we've had a no confidence vote. We will have the latest details. Plus, earnings season has officially kicked off with two of Europe's largest companies, ASML and LVMH, in the spotlight. Different performances over China from those two. We'll break that down. And CNBC's own Arjun Kharpal, I don't know who else's he would be, but he is CNBC's own Arjun Kharpal, will be live at Coinbase's London conference, where he'll be speaking to the former UK Chancellor of the Exchequer, George Osborne, about stablecoins and where Labour can go from here. That interview, 9:30 BST.
And let's get a check on how markets are shaping up. Let's start off over in the US, where it was a volatile session, to say the least. You saw the Dow, though, closing higher, but the S&P 500 and the tech-heavy NASDAQ closing down in the red. The NASDAQ, you can see there, was off nearly 0.8%. It was those US-China trade tensions, which had seemed to be on the back burner for some time, but have really come to the forefront lately. And the latest being that Trump saying that he may not trade oils with China going forward. That overshadowed what was more positive news, particularly from those bank earnings, the likes of Citigroup and Wells Fargo surging off the back of that on profit beats. But you do see US futures today, those seem to be rebounding, because instead investors are focusing on some of Fed Chair Jerome Powell's comments, signaling that a rate cut for October is on the table. Let's flip up the board, take a look at the Asian markets, because we're seeing a rebound there. You can see the Hang Seng Index up nearly 1.9%. This is after what's been 3 days of losses. Investors today shrugging off those US-China trade tensions. You can see some big gains there. Let's take a look at Europe as well. You can also see overall a positive session there for those major bourses that you can see on the board there. FTSE futures up 0.4%, DAX futures up a similar amount. Let's focus there on the CAC futures, because they're up 1.8%. There will be some focus on this as the French Prime Minister faces a no confidence vote today that is expected to win after dropping some pension reform plans. Over to you, Steve. Lots to watch.
Lovely to see you, Ritika. Yeah, colleagues are like number 14 buses between Piccadilly Circus and Putney Heath. You don't get one, then you get two coming along at once. Ritika and now Charlotte. The French Prime Minister. Good morning, Charlotte. How are you? Have you ever been called a number 14 bus?
No, this is
It's a fine bus as well. I don't know what. I say that from a very complimentary point of view. French Prime Minister Sébastien Lecornu. I still want to know if he's been Prime Minister twice or once. Bear in mind he resigned once. Announced plans to suspend President Macron's landmark pension reform until after the country's presidential election in 2027. The concession came after pressure from the left-wing Socialist Party, which said its lawmakers will now not oppose Lecornu in no-confidence votes today. Did I mention that Charlotte Reid was here? Charlotte, tell me something. What is the French for kicking it into the long grass?
To step back, to jump better. So, you have to take those step backs in order to do something. And yeah, so that's
in
how
French.
I would say. Reculer pour mieux sauter.
Oh, oui, ça va. That's what I thought. Charlotte, this is pathetic from the politicians. They are kicking the key issues in France into the very long grass, what you just said.
Yeah, but look, they came to a point where, we've seen many sacrificial lambs, and there were the prime ministers. We've seen, 6 prime ministers
Only
now
6,
in the past
like
2
more.
years. Yeah, well.
Does Lecornu count as twice?
I guess so. There's some debate around that. But look, at some point, they decided to change the sacrificial lamb, and this time it's the pension reform. And look, given the crisis that had been going on, I think a lot of people agreed that this was the necessary compromise, at least to move forward. So it's a suspension of the pension reform until January 2028, so until after the presidential election, that would be in 2027. And that's helping potentially unlock the current crisis. So, of course, that doesn't solve the deeper problem, the question of the public finances. But, maybe it was necessary division to avoid a full regime crisis, institutional crisis, and avoid the worst case scenario that would have been a potential dissolution of parliament. So that was after that, the Socialist Party that we know toppled the first the Bayrou government said they would not topple the government in the vote of no confidence that is held tomorrow. And Les Républicains as well said they would not topple the government, that they were ready for compromise. Now, Le Cornu yesterday said that, look, some tough decisions were still ahead and that the suspension of the pension reform would have to be financially compensated.
Je n'endosserai pas n'importe quoi. I won't endorse just anything. The cost of suspending the reform for our pension system is 400 million euros in 2026 and 1.8 billion euros in 2027. This suspension will ultimately benefit 3.5 million French citizens. It will therefore have to be financially compensated, including through cost-saving measures. It can't come at the expense of an increased deficit.
So you heard that the suspension of the pension reform will cost 400 million euros in 26 and 1.8 billion euros in 2027. So now all the conversation will be on the budget, when tough decisions again will have to be taken. So maybe some of those partners will, careful what you wish for. There is a suspension of pension reform. They have to be compensated. So we'll have to see more tax hikes going forward. We'll have to wait and see. But certainly we know that Le Cornu is proposing 30 billion euros in cuts and targeting a deficit of 4.7%. So we'll have to wait and see. So short-term gain, not government being toppled, no dissolution of parliament, but still a lot of tough conversation ahead.
One day the markets will care. One day the markets will take them to task for this as well. And it's not just the French.
There's some relief yesterday, though, including the spread and the yield, things to be a relief. So, between two bad decisions, this was the least bad, at least short term.